special edition of Friday's Financial Fitness. When I first started these Friday's Financial Fitness videos almost 2 years ago, my original premise was to provide you with relevant information so you could make informed decision as it pertains to your portfolio. Historically, most of the videos I've done are on educational topics, but in light of all of the recent market volatility, today I wanted to spend some time talking about what's been going on both in terms of the market as well as the economy in the last 2 weeks. In 2017, we saw the S&P 500 rise almost 17% for a total return, and then again in January, we saw the S&P 500 up over 7%. Then on February 2nd, the jobs report came out indicating that the U.S. economy increased the number of jobs for the month of January over 200,000, ultimately sending the Dow Jones Industrials down over 600 points. That started to lead to a bunch of questions. Why would the market drop if we created 200,000 new jobs? Ultimately, the reason is it wasn't the creation of jobs that makes the market nervous, but ultimately it's the increase in wages in that report that are making the investors nervous. The year-over-year increase in wages was 2.9% compared to an increase estimate of 2.6%. So, what does all of this inflation mean? Simply put, inflation is the increase of the cost of goods or services. For example, if the cost of a gallon of milk today is at $2.50 per gallon, and in 6 months it's up to $3.50 per gallon, that is inflation. So what this means is that the Federal Reserve may be a little bit more aggressive in raising the interest rates on the Fed funds policy. So concerns with the rising interest rate environment has ultimately sent the stock market down with concerns about inflation. In December, we saw the largest tax reform in over 30 years, with the biggest component of that tax reform being corporations seeing their corporate tax rates going from 35% down to 21%. So ultimately seeing a 14% increase in their bottom line profit. So where do we stand today? We have officially crossed the correction territory, which definition of a correction is more than a 10% drop in the stock market, and historically corrections are very normal. Since 1980, we've seen a total of 36 different corrections, with the last correction being in 2015 in November. So what is different about this time? The difference this time is that the economy appears to be very, very strong. As of this recording on February 12th, over half of the S&P 500 companies have reported their fourth quarter earnings, and out of those half that have reported, over 75% of them have exceeded their expectations by the analyst. And of the ones that have reported, 80% of them are anticipating a better year in 2018 than they had in 2017. So this year, we would say the economy looks strong, and we would expect continued volatility in the market that we didn't see in 2017. So as I've indicated before, it's important to put things into perspective and invest according to your time horizon.